Hey there traders, welcome back to another Commitment FX video. Thank you so much for joining me. Today we're going to be looking at 3 chart pattern formations that you guys can identify in any market, any time frame that you trade, which will increase your probability of having a winning trade. So without further ado, let's get straight into the video and identify our first chart formation. Let's go. So over here on pound US dollar, the first chart formation we're going to be looking at is what is called a head and shoulders pattern. For those of you that don't know what one of those is, I'll draw it on here for you. So let's say the market is in a downwards trend. The market trends downwards. It pushes up, has a period of retracement, pushes higher, comes back down, and then continues to the downside. And then what we have essentially is a head, we have a shoulder, we have a second shoulder, and then we have here the neckline. So it looks something like this, and hopefully you can identify this as a head and shoulders. You've probably seen this before, perhaps not known what the name is. You've got your head, your shoulder, and the neckline. And this also works in an upwards or a downwards trending market. And just think, if it's in the upwards market, you just flip this down, so it becomes a reversed head and shoulders. So how would we look to enter into this position? Well, there's 2 opportunities where we can enter into a position where we've got a head and shoulder. The first one is extremely aggressive. Well, actually, perhaps there's even 3. So the first one would be an extremely aggressive entry at the peak of the head. You'd have a very tight stop loss, so that if you are wrong, you're out of that market very quickly, and you'd have your target somewhere down at the bottom. The second point of entry would be, again, this is a downwards trending market, at the peak of the second shoulder. You'd perhaps have your stop loss at the head and your target somewhere further down. Remember, always a 1 to 3. And then the third point of entry, which is arguably the safest point of entry, would be at the retest of the neckline. So let me just draw this on for you guys so you can see. So the market has broken below the neckline. This is how we know that this is a confirmed head and shoulders pattern. We've had the formation of the shoulder, the head and the shoulder. We've had the neckline is visible, and the market has broken below that neckline. What then happens is the market will more often than not come back for a retest of that neckline and then continue in the downwards trend. Now that retest may be depending on what chart you're trading on, a few moments later. It might be a very clear retest, or it might be a single candle retest, which we're going to look at later on. So you'd have your short position at the retest of the neckline with your stop loss just above the shoulder perhaps, and then a target way down below. So this is the first pattern, head and shoulders. It is a very nice, clean pattern. It doesn't always look as perfect as this, so allow it some wiggle room to create different shapes. But essentially, the head and shoulders look something like this. So let's have a look at this on the chart. And what I've drawn for you here is I've actually got a nice example of 2 head and shoulder patterns. We've got an inverse and a standard head and shoulders. So looking at our chart, we'll look at the inverse head and shoulders. So let's say we're trading here around the 10th of November. And on here already we've got a reversed head and shoulders pattern. We've got here our head, we've got our shoulder, our second shoulder, and then our neckline. Now you'll notice the market didn't come back for the retest. That doesn't matter, it depends on your trading style when you like to enter, but you could have entered, again, this is a reversed head and shoulder if you were looking to buy this market. However, what I do suggest is you always trade with the trend. So zooming out on here, looking at the 1 hour, we are in a downwards trend at this period of time. So we're only looking to sell. So would you be buying at this head and shoulders? Probably not, but it's a good example of what an inverse head and shoulder looks like. So you've got the head at the bottom, the 2 shoulders, and then the neckline just above. So now looking at our actual example, what we've got here, and hopefully you've identified it already, is we've got our head, we've got our left shoulder, and our right shoulder. And then right down here is our neckline. Hopefully you guys can all see that. So I'll draw it on again. We've got the push to the upside. Then we've got our first shoulder, which isn't a very deep push back down. We've got our head, which breaks above the shoulder. Market then comes back down and creates the second shoulder, and hopefully continues to the downside. And here is our neckline, of course. So let's see if the market does indeed break below our neckline. Okay, so it's broken below the neckline and broken below our previous wick rejection area. Is there an opportunity for us to enter on the retest? Well, arguably here is that entry. We've had the market push back up, and again, remember it respects a zone, not specifically aligned, so the neckline would look something like this, and you've had the retest of that candle. If you were paying attention to this on the lower time frames, you probably could have put an entry in, or if not, you can put a short position perhaps as a market order, stop loss above the shoulder, and your target somewhere way down below. And let's see how the market plays out. Absolutely, there we go. We get tapped out for an almost 1 to 3. We're not playing this accurately, but you can see how the market then plays out. So I'll refresh it for you, and we can see it here. Market creates up. Again, we're looking for selling opportunities. The market is in a downwards trend. The market comes up for the retracement, and you can see as well that the head actually finishes at the previous area of support. So it's in line with the support and resistance as well. We've got the shoulder is formed. Then the head breaks above the left shoulder. The market then comes back down and creates this second shoulder, the right shoulder. Then we can see the neckline is formed. The neckline is the support level, which the two shoulders don't manage to break below. The market then breaks below the neckline, and we can enter for a much safer entry at the retest of the neckline. And as I mentioned previously, it might not be a very visible retest. It might just be a simple wick rejection, but it's a retest nonetheless. And that's a good point of entry. If you were playing this very aggressively, let's see how you would have done it. You'd have used the data from the left. So we've got a support area here. Price finds resistance at the previous level of support. It's the head of our shoulder, and you can enter your short position here with a very tight stop loss, say, and you can grab that potential move to the downside whilst the head and shoulders formation is forming. Alternatively, a second point of entry is on the right shoulder. You've identified that this is the creation of a head and shoulders pattern, and we've got the neckline here. The market has created its head and then immediately broken back down to fall in line with the left shoulder. The market fails to break above the right shoulder. That's how we know that this is a finalized head and shoulder pattern, and you can enter market order at the formation of the second shoulder, perhaps with a stop loss around the head area, and then a continuation to the downside. So there's 3 different opportunities to trade from a head and shoulders pattern. You'll see them come up more often than not. They're not always perfect formations, but the overall idea is always visible. You have a neckline, left, right shoulder, and the head which is broken above and immediately comes back down. You'll also see this on bigger time frames like the daily. Let's see if we can pull up an example of a head and shoulders pattern just by looking at this chart. Let's have a look. So I've found an opportunity to highlight this on the daily candle chart just to show that this head and shoulders pattern affects all different types of time frame. So what we've got here is we have our head. We've got here our left shoulder. We've got here our right shoulder, and then the neckline just below. Again, they're not always perfect formations, but as long as you're identifying the shoulders and the head, which is broken above the shoulders, then you can say it's a head and shoulders pattern. We've got the neckline, the market breaks below the neckline, comes for that retest, and then you enter to continue to the downside. So you can see that even on the daily chart formation, the daily time frame, check it on whatever time frame you trade, you'll be able to find a head and shoulders pattern, and you'll be able to trade from it using those 3 entry points to enter a market with a higher probability of success. Let's move on to our second one. The next chart pattern we will be looking at is what is called the wedge or the flag pattern. These can be used interchangeably, but essentially they do the same thing. So let's have a look at how this is going to play out. A wedge formation is very simple. We've had a nice, let's say, push to the upside. Then the market makes a series of formations. It fails to break either a low or it fails to make a series of highs. And what we have essentially is the market moving sideways for a period of time, albeit perhaps in a certain direction in which we can identify a trend line. What distinguishes a flag pattern and a wedge is what happens at the bottom or the top if we're reversing of the pattern. So here on the bottom, let's say the market fails to break below. It holds the support area, but what we see here is the series of lower highs are getting smaller and tightening up. It's creating a wedge. If you think of like a wedge of cheese, a door wedge, something where it comes to a very fine point. And that's what we're having in the market. Now, we don't want to be trading in a market which is moving sideways. It's very difficult to ascertain a trend. It's very volatile in some cases, and we like to identify the trend and trade with it at all times. So what are we looking for when we see a wedge formation? Well, what we're looking for is that explosion either to the upside or to the downside of the wedge. Now, in identifying whether it's moving to the upside or the downside, you want to be looking at, first of all, your commitment of traders data. If you're unfamiliar with the commitment of traders data, head over to commitmentoftradersclub.com, become a member, and what you'll find here over on our site is what's called the Commitment of Traders reports. And these are reports published by the banks and institutions every week, identifying which direction they are looking to trade in. And when you're looking at wedge formations, even head and shoulders patterns, it is essential to understand what the banks are doing with their money, as they are moving money more aggressively and cause the chart to actually create these patterns. It's not retail traders that make the market move, it's the banks and institutions. So knowing what they are doing is vital to success in this game. Let me know in the comments below if you need more information, and I'm happy to provide. So back to our chart. We're looking here at a wedge formation. We can see that the price is getting tighter, we're getting to a finer point. So we know that there's going to be an explosion to the upside or to the downside. Well, how do you identify that? Again, check what the COT data is doing. What are the banks doing? Secondly, well, what is the overall trend of the market? If the overall trend of the market is to the downside, and I'm talking here on the daily, the weekly, then there's a good possibility that this push to the upside was the retracement. The sideways movement or the wedge is a distribution of funds from institutions. They're letting go, they're closing out some of their positions and perhaps building up positions in the opposite direction or adding to the further positions. So let's say on the overall time frame, this push to the upside was a retracement and we're looking to sell this pair. What we can then expect is a very aggressive explosion to the downside. Now there's two options for us to trade this particular pair. The first one is we have a very aggressive market entry at the pinpoint of the wedge. So it might be, and again, if we're selling, we want to get the best entry, so it'll be at the peak. So we put a short order at the peak with a stop loss perhaps just above the trend line, and then our target will be somewhere way down looking at the overall time frame. And what we will expect the market to do is perhaps trade a little bit longer in this wedge, but then explode very aggressively to the downside. That's what we're looking to do. Secondly, what we could be doing, and arguably a more safer entry, is we wait for the market to have the aggressive push to the downside, come for a retest of this resistance line. So it was support, now resistance, and then we look to enter a trade at the resistance for a continuation to the downside. So let's see how this translates over onto our chart. So we're looking here at the daily. Let's remove these drawings. We're looking here at the daily, and let's check what the overall trend is on this pair. Well, we have had a very nice impulse to the upside, but what we can see is the market has found its second point of resistance. We've had a previous resistance on the 20th of Jan 2016, and now we've come again 4 years later for another resistance. So there's a good chance that the market isn't going to break above, considering it's reacted quite heavily from this. But we need to check our COT data. Checking your COT data, you understand that the banks are looking to sell this pair. Zooming out on the weekly, let's just double check. The overall trend on the weekly is actually to the downside. We have created a high, but we failed to break above and we're trading down again. So arguably we've got two confluences there, let's say, for a short position. Now looking at the chart, what can we see? Well, we've had this recent high, which was not successful in breaking above. We've now got this wedge formation, and let me draw this on here for you. We've got our support line, which has failed to find any point where it has been broken. It's been supported very nicely. But what we are having here is a series of lower highs which are pushing to the downside. You can see here now we've got the wedge pattern drawn on our chart quite nicely. And again, you want to try and get it so it matches up most points on the chart, so it can intersect at some points. But drawing that down, what we can see is that the chart is getting tighter and tighter. So we do know that there's going to be an explosion at some point. It is very difficult to tell if it's to the upside or to the downside if you're not looking at the COT data. If you are looking at the COT data, you'll see that the banks and institutions are adding or closing a certain number of trades, either to the long or to the short side, so it's easier to identify. So we know that this is going to short. We've done our research, so we've got two options. Our first option is we can have a short position at the previous peak of the wedge formation. So let's say we managed to put in a market order at this wedge, and our target would be, let's say, somewhere down here. Secondly is we want to wait for the market to have that explosion, that volatile explosion to the downside, wait for the retest of our support, which will then turn resistance, and then we can enter a much safer trade. So let's see what happens with a order at the peak and then a order at the retest. Okay, so we've started to have our explosion. We've broken nicely below. Let's see if this continues. Okay, it looks like it has been continuing for a very nice period of time. Did we get an opportunity to enter at the retest? Well, on this occasion, unfortunately not. Unless you were trading this and watching it very closely, you perhaps could have entered at the very brief moment of pause that the market created after this big bearish candle to the downside. You could have had an opportunity to find this as resistance to our previous support. But ultimately, you can play this in two ways: have a very aggressive entry or wait patiently for the retest. It may or may not come, but it is a safer moment of entry. As you can see, the chart tightened itself together and then had this explosion to the downside. And this is happening on the daily. This can also be found on the 4 hour, the 1 hour, even the 15-minute chart. Just got to know what you're looking for. Let's get on to the third one. The third pair we're going to be looking at is one of my favorites, and it is one which can be identified very, very easy. It's the double top and double bottom formation. So to summarize, what is the double top and double formation? Let's say the market is moving to the upside. So we're in a downwards trend at the moment. So the trend is coming down for whatever reason. It may have been a retracement. Pushes down, it creates a low. Market pushes back up, and very simply, it creates another low which fails to break below the previous. And then, consequently, the market pushes back to the upside. So you may have seen me refer to this as the W formation or the M formation. And essentially, all it is a double bottom. Very nice and easy. We've got one bottom, two bottoms. And they are very powerful trading chart patterns. Very simply, the market is telling you that it's had a second retest of the low or the high. Essentially, if you're reversing this and it becomes a double top, the market has failed to break below. Therefore, there's huge buying pressure still in the market. And usually what follows is a push to the upside. Again, there's two opportunities to enter this trade. The first one would be to have a buy order at the double bottom or the double top, depending on which one we're looking at. So here on the double bottom, you would have a buy order at the finalization of the double bottom. Check to see that whichever direction you're moving in, there's been a fizzling out of orders. Let's say some wick rejections or indecision candles. These are all good signs that the double bottom has created and that the market doesn't intend to break below. Where would you have your stop loss? You would have your stop loss just below the previous leg of the double bottom, and your target can be wherever. Very aggressive, very tight stop loss entry to the double bottom. Alternatively, what we can have is an entry at the retest of the W or double bottom formation, which will be at the peak. What often happens is we have the W or double bottom formation, market breaks above, and then very simply, it comes back to find a retest at the previous area of resistance, which will then turn into support. And that is a very easy opportunity to enter a position and gain access to the potential market move following on from this rejection of a major level. There's one thing you need to remember, and I've just said it just there. This pattern has to happen at a major level. Wait patiently for the market to create the first peak of, or the first position of the double bottom, the first rejection of that major level. It may come for the second. That's when the double bottom is created. So let's look at it on the chart formation. So we'll remove these drawings. So we are looking here at Euro New Zealand dollar, and the double bottom has already been formed. Again, these aren't perfect chart formations. Nothing in the Forex market is perfect. But what we have here is we have our first and our second low. Market failed to break below. So we have, very simply, a double bottom. If I draw this on very simply, so you can see we've had a push to the downside. The market came back up, came for a second retest of this support zone, failed to break below, and then what we're expecting is the market to continue to the upside. If I draw it on like this, it becomes very clear that this is in fact a double bottom. And you'll see this on multiple occasions, even just looking here on the left. Let's say we've got a zone here, and you wanted to trade this to the upside. I'm not sure why, we are in a downwards trending market, and I'll get to the point of why we're trading this to the upside. Is you've got a very nice double bottom, and again you can draw it on in a simple way. You've had this push to the downside, push back up, create the double bottom, and then it moves to the upside. They're never perfect, but they're always there. You can find them very easily. So removing our drawing, we've got our double bottom created here, in the sense that there is 1 and there is 2. And what happens? Well, hopefully the market pushes to the upside. Where would we enter our trade? Very simply, we could have a trade as a long order at the second creation of the double bottom, so the finalization of the pattern. Stop loss would be below the original dip and target wherever. The second one would be, we have the peak of the double bottom, so the W formation, the peak of the letter. Draw on our zone, wait for the retest. Do we get a retest? Absolutely we do. Let's get rid of this original one. Absolutely, here is our retest of the resistance zone, now turned into support. Do we enter? We can enter there. Market order, stop loss, you can have it just below for continuation to the upside. It's a very, very simple chart formation to understand. Not always clear, but always there. Why did we look to buy this one? Well, zoom out on the chart. We are trading in an upwards trend. As you can see, from 2015, we've been creating a series of lower highs and higher highs. Had a little bit of a downwards push, but overall the market is to the upside. So the overall trend is upwards. That's what we're looking for. And you can see that here on the weekly, that in fact that created a huge bullish push. So traders, 3 very, very simple chart formations to understand. Backtest them, find them yourself. Again, they're never perfect, but they're always there. You just have to look out for them. Certain asset pairs, certain currency pairs have more or less than others. So do backtest, find them for yourself. If you have any questions, let me know in the comments below. In any event, we'll see you guys on the next video.